cash is disappearing. In Sweden, fewer than 1 in 10 purchases use bills or coins. In China, mobile wallets handle well over 80% of transactions, and India's UPI moves billions of payments every month. That convenience comes with a cost. Every coffee, charity donation, and rent payment can be cataloged, analyzed, and sold. Governments can use that trail to freeze accounts or map protest activity. Banks can flag and scrutinize ordinary behavior. And tech platforms turn purchase histories into razor-sharp profiles for surveillance or profit. In this video, you'll see exactly what payment systems record, who gets access to that data, and real examples of how it's already been used. Stay with me, and you'll walk away with 3 practical ways to reduce your financial footprint. No techno-mystery, just clear steps to protect what's left of your privacy. An analysis of the transition to CBDCs, central bank digital currencies. What happens if physical cash vanishes entirely similar to the trends in Sweden or China but on a global scale? Central banks around the world are actively testing digital versions of central bank money, and a handful have already rolled out national retail CBDCs or pilots that touch millions of users. Sweden's payments market is a frequently cited example of near cashless daily life, where many shops no longer accept cash and mobile apps dominate point-of-sale transactions. China's ecosystem, powered by large private platforms, demonstrates how instant digital payments can become the default for everything from street food to public transport. The Bahamas offers a concrete case of a sovereign retail CBDC in circulation, and several other countries have live pilots and policy frameworks in development. If physical cash were to vanish globally and CBDCs became the dominant vehicle for retail payments, ordinary transactions would generate institution-level records by default. Every CBDC transfer can be structured to leave metadata: sender, recipient, amount, timestamp, and potentially location or merchant category. Some designs can minimize data retention, but the default operational models being tested by central banks often integrate KYC and audit trails at the first on-ramp. Picture a commuter paying with a central bank-issued wallet. That tap could create a traceable entry accessible to regulated intermediaries and, under legal processes, to authorities. Retailers would have richer, instantaneous revenue feeds, and tax collection could be automated, receipts and VAT reconciliations happening without separate input. Privacy protections will depend entirely on choices made in protocol and law. There are 2 broad technical architectures: token-based systems that aim to emulate cash-like bearer transfers, and account-based systems that resemble bank accounts. Token models can be implemented with cryptographic anonymity techniques, such as blind signatures or selective disclosure using zero-knowledge proofs. Account models rely on identity-linked accounts, and therefore enable straightforward surveillance unless constrained by policy. Several central banks have publicly discussed tiered models: small anonymous or pseudonymous holdings for low-value transactions, and fully identified accounts for larger balances, which would preserve limited transactional privacy for micropayments, but not for high-value activity. Implementations that include offline modes, secure hardware wallets, or limited-value disconnected tokens can provide privacy and resilience, but they introduce significant technical trade-offs and attack surfaces. The policy lever effects of CBDCs change incentives for governments and financial institutions. Central banks would gain new tools for monetary policy. For example, targeted stimulus transfers into individual wallets can be executed instantly, and negative interest could be applied to idle CBDC balances without the intermediary layer of commercial bank deposits. That same capability could enable time-limited, one-time vouchers or targeted subsidies directly to citizens. On the other hand, the ability to freeze or claw back balances centrally raises concerns. In a cashless world, administrative errors, overbroad sanctions, or politically motivated asset restrictions could lead to immediate loss of access to funds. Consider a migrant worker who owes a disputed debt. Without cash, a court order or administrative flag could prevent them from using the primary vehicle for daily purchases until resolution. Commercial banks and payment platform providers face structural shifts too. If households hold significant CBDC balances directly, deposits at commercial banks could shrink, pressuring bank funding models and lending capacity. One response is a two-tier approach where central banks issue CBDC, but commercial banks and fintechs remain primary customer interfaces and provide wrapped services, risk assessment, credit, bundled financial products, thereby preserving intermediation. Another is the so-called synthetic CBDC model, where regulated private entities issue digital liabilities backed by central bank reserves. Either route shapes who holds transaction-level data: the state, private intermediaries, or some hybrid. Financial inclusion is often argued as a core benefit of CBDCs. People without traditional bank accounts could receive digital money and access payment rails through low-friction on-ramps. That is a valid potential gain, but exclusion can be reproduced in new forms. Elderly populations, rural communities with intermittent connectivity, and individuals without legal identity documents may be sidelined unless robust offline options, simplified onboarding, and public support exist. Cybersecurity becomes existentially important as well. A national CBDC network is a high-value target for cyber attacks. Resilience against large-scale outages, sophisticated theft, and systemic failures must be far stronger than current retail systems. Cross-border consequences would be profound. CBDC architectures could make capital controls easier to enforce. Authorities could restrict cross-border transfers at the protocol level or require compliance checks on foreign counterparties. That may help policy goals for some states, but would complicate remittances, global trade finance, and the multinational operations of firms. Interoperability, standards, and international agreements would be needed, and the geopolitical asymmetry in technological ecosystems could give certain states or platforms outsized influence over global payment flows. In parallel, privacy-focused cryptocurrencies and informal cash-like networks may expand in response, though many governments have signaled stringent controls on such alternatives. Finally, social and behavioral effects should not be underestimated. When money becomes programmable, spending can be directed or constrained automatically. Benefits could be limited to certain retailers, or subsidies could expire. Retailers could implement dynamic pricing tied to customer profiles, and consumers might be nudged toward particular behaviors through offers embedded in the payment layer. That could yield efficiencies and targeted welfare delivery, but it also normalizes ongoing behavioral surveillance and automated control over economic choices. The loss of anonymous cash removes a long-standing avenue for discrete transactions, everything from petty commerce to sensitive personal expenditures. So debates over rights to financial privacy, the limits of state intervention, and the appropriate balance between surveillance and security will become central to policy choices around CBDC design and deployment. Total state control over every single cent. Imagine a world where you cannot buy cigarettes because your health score is too low, where you are blocked from purchasing protest gear because of your political activity. Central bank digital currencies and digital identity platforms can make money programmable, turning payments into conditional instructions rather than neutral transfers. Payment networks already classify merchants with category codes and enforce rules. Car brands and processors routinely block entire categories, such as illegal drugs, some types of gambling, and sales they judge non-compliant. Anti-money laundering and know-your-customer regimes give banks legal authority to monitor, flag, and freeze accounts on suspicion of illicit activity. Sanctions lists similarly cause automatic rejections of transfers to designated persons. Those are not theoretical features. They are existing controls that become far more immediate and granular when every transaction flows through a traceable, centrally governed ledger. Linking health data, identity credentials, and a programmable wallet is technically straightforward and already reflected in parts of the private sector. Wearable devices and employer wellness programs feed activity and biometric metrics into insurer dashboards today. Some insurers offer incentives tied to those readings. If a state or a regulated payment system were permitted to read a health score, the wallet could automatically refuse purchases deemed harmful, tobacco, vaping products, or sugary foods, without any cashier interaction. The result is not only denial at the point of sale, but also automated rationing, daily limits, merchant blacklists, and conditional allowances set by algorithmic policies rather than by human clerks. Political behavior can be treated the same way. Payment platforms and banks have already debanked organizations or frozen accounts in response to allegations of extremism or illicit fundraising. Extending that authority into a universal digital currency allows authorities to tag individuals with risk scores reflecting protest attendance, online posts, or affiliations. A flagged account could be blocked from buying certain items: masks, megaphones, protective gear, or even transport tickets, because those purchases are labeled as protest-related in the classification rules. Private companies that provide compliance services can enforce such lists across multiple jurisdictions, meaning a restriction placed by one authority can ripple across global payment rails with a single API call. Concrete, human consequences follow quickly. A smoker denied a pack at a neighborhood kiosk faces an automated refusal that leaves no room for appeal in a moment. A community organizer finds crowdfunding donations repeatedly reversed because payment compliance software flags their profile. Families dependent on remittances discover transfers halted when senders' wallets are frozen for political speech. The architecture enables not just targeted interventions, but broad deterrence. The knowledge that every purchase, donation, or subscription can be monitored and acted upon changes behavior. Citizens may self-censor, avoid legitimate associations, or seek opaque intermediaries to preserve basic privacy. Actions that in turn create new markets for illicit cash services and increase vulnerability for those who cannot access them. We began with one simple fact. Money is moving from your pocket into servers, and that move changes who sees your life. Digital payments are already dominant in places. Cash payments in Sweden are down to around 1–2% of transactions. Mobile apps handle the majority of everyday purchases in China, and systems like India's UPI move billions of transactions a year. That scale brings convenience and lower crime, but it also brings centralized records, programmable money, and new levers of control. The core takeaways: digital payments make spending transparent. Centralized systems and CBDCs create points where privacy can be removed by design. And without legal safeguards, exclusion, surveillance, and conditional access become real risks. If that feels unsettling, you're not alone. Many people worry about being tracked for what they buy, where they go, and who they support. There are practical steps you can take today. Use cash when you can. Choose services that limit data collection. Push companies for stronger privacy settings, and press lawmakers to build legal protections and opt-outs into new systems. Support organizations fighting for financial privacy and hold policymakers accountable. If you found this useful, like, subscribe, and share your experience below. What payment habits do you refuse to give up? In the next video, we'll break down CBDCs in plain language, how they'd work, real-world pilot examples, and whether a digital currency can coexist with privacy. Stay curious, stay informed, and don't let convenience be the only currency you trade.